Well, that was a bit of a disaster. The US just held its 20-year auction, and let's just say the results weren't so great, with spikes being caused across the board as markets looked for high yield to take on the risk. And as we expected, dark pools were ahead of the game, and in today's video, we'll take a look at what that means as Wall Street potentially set up to sell into us as retail traders. We're the most leveraged we've been in a while. We've seen a huge amount of money flow into alternative assets, and that could be still just getting started. Bitcoin is at all-time highs. Guys, join us as we cover stocks, commodities, and cryptos in what is going to be a very special video. Well, welcome back everybody to The Daily Show. My name's Tom, and in today's video, we have a lot to discuss. The latest macro, the big data, and of course, those dark pool trades from Wall Street. Just a quick shout out. I know a few people were wondering where I was. Unfortunately, I felt quite sick, but we should be back to the daily shows for now. So thanks for sticking with us. And of course, if you wanted to get a couple of updates, I did post over on X, links in the description down below. So as we've been warning and talking about, we saw the market, we saw Wall Street move defensive over the last 3 to 4 sessions. Now, what that means is they started going into bigger defensive stocks, things like utility, staples, and healthcare. And we'll look at that a little bit later on, including gold. And they were looking into alternative assets. But let's kick things off here with the pretty bad US 20-year bond auction. And this could be a precursor of what's to come in the third quarter of this year. Demand kind of collapsed during the session. Yields had to spike. And it was one of the weakest auctions in years. And this basically means that markets started to get a little bit worried across the board. And more importantly, they're demanding higher compensation. And it's not just in the US that we're seeing this. Take a look here at Japan. The 30-year bond yield is going bonkers right now, back up to 3.13. And you might say, well, this doesn't mean anything, whatever. You know, we've seen these types of big rallies before. But this is part of a bigger problem. We've got more debt than ever before. And remember, the US has to actually finance that debt third quarter, fourth quarter, and early 2026 with huge rolls that are coming. So the question then becomes, have we hit a recession? Well, oftentimes, whenever we're looking for a recession, guys, we're often looking and seeing whether there's any signs of it happening underneath the hood. Now, generally, the street, of course, that is the Wall Street, they'll be ahead of us and it'll show in the flow and it'll show in the dark pools. But take a look here, at least from March, and you can see here that most states were actually doing okay. I want to alert somebody, you guys, to this, I guess, but it was just to do with Jamie Dimon, who's obviously the CEO currently of JP Morgan. Firstly, it looks like he's going to leave. Secondly, he said it's getting ugly out there. And of course, he's sold some of his stocks near the high. Now, we just recently got some filings that showed that Warren Buffett has also sold more banks and particularly deleveraged his bank positions even further. So what is this telling us? Is there something wrong in the system? Is something incredibly sick? And these guys know, but of course, timing will be everything. Are they earlier to the game? Well, we kind of suspect that could be the case. And of course, it may be that it's 2025, but probably is going to be 2026 where something really bad happens. And while we expected 2025 to be tough, we thought we would hold out until the third quarter, fourth quarter in terms of still seeing some form of up, down, all around market. And you'll see why we could still make an all-time high very soon for a couple of valid reasons. Now, a lot of people have worried about treasuries and saying, oh, the liquidity is dead and everybody is all owned by overseas and it's really bad. Well, actually, only 33% of the US Treasury market is owned by overseas. Financial sector owns, of course, a lot. Government owns a lot. Households own a lot. And then some is owned by the pension funds. But what is the most likely path we're on? Well, we've got two kind of scenarios here for the paths. And the first one is, of course, what we're seeing from Trump's administration so far, which is, of course, that we had a 20% fall off thanks to the tariffs and some other stuff. And then since then, we've rallied up as some of those have been relaxed. Now, funnily enough, this happened when we saw a few other presidents that had some pretty big reforms. And we actually saw rallies to generally sometimes all-time highs during that period. But then something weird happened around 200 to 250 days. And we started to really fall off, or in the case here of Ford, we actually went up and continued to rally. So it's something, of course, you could be watching and looking at. Now, as we mentioned, the defensive actions here were pretty big over the last couple of days. And yeah, we saw 5-day rotations into gold, massive spike, 5-day rotations into Bitcoin, massive spike, 5-day rotations into staples, utilities, and healthcare, massive spikes. So all across the board, they've been up. And this shows really in the last 24 hours of trade as well, where we have, fall offs across really a lot of these other sectors, such as KRE, which is more sustainable to these high yields, and even financials. So there's a couple of problems there that are starting to occur. Now, when it comes to big dark pools, guys, you guys know that we always look for these. And when it comes to dark pools, we're always looking for those large transactions. And we did see some clusters here that continued to spike the same level. So we have the line in the sand. It's 522 on the Qs. You can see here so many transactions coming through. And while none of them in particular were that large, it was the combined brute force of probably the algorithms on that level that really caused it to go through. And I shared some of these in our private group, as of course I wasn't well enough to do the videos. But basically these just show exactly what we already suspected on our weekend video, which was our last one here on YouTube, where we started to think that we were at resistance and we might see some dark pools. Well, as it turns out, we did see some dark pools, and you can see here that we've had those transactions through those same levels. So does this mean that it's all over? Well, actually, smart money started to increase its bidding over the last couple of weeks. And of course, they bought mostly all in that one session where they went bang and they just basically super bought up. And that was during the peak of fear. But they've started to add little bits, as some of them are probably trying to play catch up to the markets. But that doesn't mean that it's not at some form of temporary resistance for now. Bullish percent index, one of our favorite reads for the S&P, and bullish percent index for the NASDAQ both show overbought action. And of course, the RSI also shows the same thing. And even equity margin has now already spiked all the way back up to the peak before we saw kind of the sell-off here earlier this year. That basically means more people are levered than ever before. More people are feeling absolutely great about buying the dip. And we actually saw the fastest ever buy the dip on Monday by retail. And we know that this is a retail net imbalance because effectively retail is purchasing in these periods of time, and that's where the flows are coming from. We just saw $4.1 billion on Monday, which was the biggest midday buying spree ever. So could it be that Wall Street wants to trap some positions here? Maybe say, you know what, haha, you bought the dip, we push you down, and then maybe we rally later. Well, of course, they love doing that. So this is, of course, one of the things that we could be looking at. But in general, we're following probably the most closely now, still either the kind of 96 scenario, or not really exactly the 98 scenario anymore, but still the possibility of being there in the cycle. So effectively, we're at these kind of points in markets at this stage. Some good news is we were led by semiconductors on the way up, and technology. Obviously, we know that is a big sign. We've talked about that before. And of course, earnings is still going on. And so far, this earnings is pretty good. And it really just matters about the next earnings and how that goes. Obviously, that's going to be the big key influential point. When it comes to big markets here, guys, big central bank equity and flows, it doesn't seem like liquidity is being pumped in anymore. So for about 2 weeks now, we've actually seen a lack of liquidity from the street. And this is coming from, of course, the Fed and other central banks around the world. And that also may take a little bit of a dampening effect here, where we could see the markets pull back. And the question is, where will these markets pull back to? Well, ideally, they at least make it back down to the 5,600 to 5,660 zone. And you'll notice here there's a big gap fill sitting around 5,660, which comes off the US-China trade deal being announced. And obviously, there's huge gaps that have been left from a couple of spots. Now, gaps don't have to necessarily fill, but as we've talked about, we've got anchored VWAP, we've got a 50-day moving average, we've got a 20 just above it, we've got Fibonacci, we've got plenty of things. We've also got one of the most traded zones throughout this whole range, which we've talked about several times over. So we've got a lot to like about this 5,600, 5,660 should the markets come back. It also just happens to be around the same point of fall that we saw during the last downgrade of the US. So obviously Moody's downgraded the US recently. And the last time we've seen downgrades, one of them was a big fall. And the second one we actually saw around a 5 to 6% drop, which actually takes us to around that 5,600, 5,660. Now, in both cases where we saw downgrades from these big banks and financial institutions, what ended up happening here was that we ended up at all-time highs, and we ended up actually very bullish after that. So it's not that a downgrade necessarily has ever led into a massive crash straight away or anything, but it has led into sometimes a catalyst to create a pullback along with some of the other things that we've got going on. So let's have a look here at what's going on with the S&P 500. You'll notice straight away that we have a market that has gone from a series of higher highs and higher lows being completely up in the trend and has literally not changed this since we broke out from the US-China trade deal, and it suddenly made a lower low. Now, it's sitting right on a put wall, as you'll see in a moment, but we did break underneath 58.80, and it means that if rallies do occur now, there's going to be a lot of fighting around the 5,900 point in particular. And what we can do is we can actually take a fixed range volume profile, and we can have a look here at this range on the way down and recognize that there's a few different zones that we could be looking at. So, of course, there's a lot of trade here at 59.50, which makes some sense. And then if we pull this across, what we'll notice is we have a ton of trade, and this is the actual level I was looking at, 59.13. It's about right. So, yeah, we could be going to somewhere in between here, and this is where the bears will want to basically recommit if they're going to in terms of trading to the short side. And there might be a few reasons we could still rally here today over the next session anyway, and that's because options high level is about 5,900, and if you actually look at the puts, take a look how many puts there are here. If we drop 58.50 over the next 24 hours, that can create what we've seen before, which is like a waterfall or a cascade effect. And these cascade effects, as you guys know, can cause very quick, sudden movements, which can be kind of like, 2, 3, 4% in even a session, because all of a sudden there needs to be so much hedging done due to the massive amount of puts that suddenly start to appear. But what you can see is we've entered back into negative gamma as soon as we break through that level. So effectively what's been really, really positive, everyone's been trading to the upside. We see one bad day, one bad session, and all of a sudden everyone wants to buy puts, which is always a little disturbing if you are looking for that pullback in markets. Tesla, same kind of thing. We talked about 350 at great length in terms of being a call wall. And obviously we expected it to fall from that level, and it's fallen to 330, which just so happens to be a put wall. So we're stuck within those two ranges. Again, we break one, we're probably on for a bigger move. And the same thing happened here with NVIDIA. And as you'll see in the price charts a little bit later on today's video, there's really no excuse for NVIDIA not to have tried to sell at that point, because 135, big key resistance. And then we see that kind of uptick yesterday and then rejection straight back down from that as we saw the 20-year bonds get auctioned. All right, some interesting stuff there, but let's now jump into the charts and take a look at some of the key levels that we have been watching. So let's take a look at the charts that matter at the moment. And the big one here is, of course, going to be put-call ratio. Only 24 hours ago, it was sitting at about 0.66, which, as most of you guys that have watched the channel for a long time would know, is kind of that area where you start to say, if we're at a key resistance, then maybe we should be looking at some weakness or possibly a pullback in time or something like that. Whereas now we fast forward and we can see here that puts did start to come in straight away. Now, particularly this is really good when, of course, you get huge amounts of puts stacked into the market. And this often gives us a put base. And realistically, these are areas between 1.2 and 1.4 that you want to be starting to buy the dip pretty cleanly. But at this stage, we're in the middle. We have come off, of course, a low level of puts, and we're starting to now see them stack even with one day of sell-off. When we have a look at the bonds indicator and we look at yield spread differentials, you can see here not too much freak out in that particular section of the bonds market. We do find this to be the strongest read in terms of buying the dip or actually, really getting out and running away. And we obviously saw that turn back in April, which led us to believe that we had at least a temporary bottom in. And yeah, since then, of course, it's been continuing to decline, which basically means that the market at this point is prepared to take the risk when they're buying in. We see something similar with that smart money index. Same thing here when it comes to bonds indicators. When you're taking out yields, realistically, what this is showing us is that, yeah, a little bit of risk off over the last 24 hours, but nothing necessarily to be terrified of just yet. What about the US dollar? The US dollar obviously has dropped. This is continuing to drop. Now, it's strange because when you think about it, the US dollar should be going up if yields are going up. But this just shows you some of the big key things that are happening in 2025. Dollar is putting pressure on the 99 level. This 99 to 98.50 is going to be the key zone for us to watch. And when we're looking at that, what we've actually seen is something we suspected was going to happen last week, late last week, once we saw the turn, which was that gold and silver might actually break out. And of course, if Bitcoin got a nice weekly close, it would continue to rally on, or at least be strong over the next couple of weeks. Now, in this case, gold has seriously done that. Let's have a look here. Gold, 3,340, going back up to this resistance supply area and really breaking that trend of the downside. Now, only probably about 2 weeks ago, or even less, you were looking at gold potentially going all the way down to 3,030. But as it changed and it came back up to this supply, something very interesting happened. And this, of course, then pressured this high, and it made us think, this is probably a trap towards now going super long. And that's the thing about being a technical analyst or anyone that's going to be like a trader, is sometimes you got to flip your opinions. We're obviously super long gold on the higher time frames, but when you're talking about these smaller ones, things can switch, and that certainly was a trap set by the street, and you can see that was actually affected in price. Silver's doing really well. It's hit to this big key zone that we're obviously very, very, very much looking forward to breaking through. Looks like it probably will try to do so. It's at 33.60 now, and we've been looking for silver to outperform gold for quite a month and a bit now, I think. And it looks like it's starting to do so, and it might even be breaking out. If it gets past 34.50, yeah, you know that silver could be getting a special on this channel, because at that point, we could be doing some serious breakouts. Tesla, Nvidia, semiconductors. The leaders have now become a little bit of laggards, and you can see here all of them rejected over the last 48 hours, where we got these kind of wick rejections off those core walls. So we've had these core walls in our show for quite a few sessions. And really what this is it's a little bit of TPing, a little bit of take profit zoning. Maybe we get a pullback now. But you can see here the same thing happened with NVIDIA. And I think the thing with NVIDIA is it spiked a new high before then really getting taken back down. So that's actually quite a large shift in the session. So if we actually take the high to the low, we had a 4.89% shift in NVIDIA, all at that positive gamma core wall. So this, of course, opens up the possibility of getting back down into those, 120s again as well, or even the gap fill at 116. So yeah, certainly there are some potential signs that we could be getting gap fills on some of these major markets. Similar thing happened on semiconductors, rallied then dropped after we found out about the the US 30-year going over 5%. But again, I think this is all a catalyst effect to already what Wall Street was setting up over the last couple of sessions, more defensive, that kind of nature. What about Google? Google actually fared really well, still underpriced in our opinion. We've done some fundamentals on the show on that one. Still looks pretty good, even though it is at resistance at this stage. And China, although it did spike to a new high, fallen a little bit off this point. It's still in what we would think is consolidation at this stage. And we still remain bullish on China over the next 6-12 months, because it's still coming out of a recession and seems to be doing a lot of government stimulus. US 2K, if you have a look here, you can see it's dropped more substantially than the others. The small caps struggling with the realization of potential really tough financing later on this year. And yeah, we're getting close to already that gap, which actually was the one that was caused from the US-China trade deal. And then, of course, the NASDAQ. Now, the big thing about the NASDAQ is that we barely made it below the low of the previous session over here, which was the Monday that was bought up big time by retail. So we know that this was bought by retail at the fastest rates ever. We also know that we've got a dull market. This could be a distribution. So you can keep open eyes to that kind of thing. And we know that the US 500 generally leads. So the US 500 is sitting on 58.50. So it's, we're right on these puts across the board. I would be interested to see how this market ends up reacting. I could see it go back to like a 21.3, like a very heavy trade zone up there, and then maybe try to reject back down. That would be probably the most logical. If the US 500 gives up 58.50, then of course the NASDAQ will drop as well. But we're still at that level of just barely holding onto some support. And I think for people that, kind of just tried to time the market up here, they'll be looking at this level very closely and hoping it, of course, breaks to the downside if you want that deeper pullback. Now, what about Bitcoin? Had a great weekly close, had a pullback, then it just rallied 110 all-time high. So obviously the stablecoin news, and also just in general, just a very strong movement into alt assets at the moment. Again, does the market see something that we don't quite yet? Are they concerned about the future of, maybe the global stability and economy? That certainly could be a big case. So you can see here, stability, rallies, stability, rallies. And in this case, it's just continuing to rally on. So what's the next stop? I'll let you guys decide in the comments down below. I had 125 originally, so we'll see whether it can get to that, or maybe it's going to go even more. In terms of everything else, guys, the big thing is that, of course, we are waiting on more news about potential tariffs. We're starting to get in on those 90 days now, so people are going to start to question what's up and coming. But I think it's all about yield. So watch the US 30-year over the next 24 hours, and particularly watch the big movement on 58.50 on the S&P. If that level gets taken below, then that could create a waterfall or cascade effect. It's great to be back. Thank you so much for bearing with us. Glad to be feeling a lot better. And thank you also for subscribing to the show. Just a quick reminder, if you're from or you can get to Sydney, Australia, in the 4th of June, we've got a free seminar or webinar event kind of thing, which is going to be awesome to meet you guys in person. And we've got that all running there. So click on the links in the description and pin comment down below. And we'd love to meet you. Bye for now, guys. I'll see you in the next one.